What does a higher for longer rate backdrop mean for client portfolios? Hi, I'm Matt Wrzesniewsky. In today's video, we'll talk about the latest data, CPI and PPI, the resilience of the bond market, where we're seeing the most compelling fixed income opportunities, and how advisors can best position clients beyond the safety of cash. What the recent inflation data reinforces is that inflation isn't clearly reaccelerating, but the backdrop remains fragile. Core CPI and PCE have been relatively steady, and PPI suggests underlying price pressures aren't building in a way that would force the Fed's hand right now. That said, there are signs that near-term inflation risks have ticked up, particularly around energy. After the experience of recent years, the Federal Reserve is more cautious about declaring victory. So temporary pressures have a way of lingering, which raises the bar for rate cuts and supports a higher for longer rate environment. Importantly, the United States is in a different position than other regions in the world. As a net energy producer, the inflation impact here is more balanced, giving the Fed more flexibility to stay patient, but not complacent. For financial advisors, that argues for staying invested in fixed income. With yields across much of the bond market still above 4%, income can do a lot of work. And if energy prices eventually weigh on growth, that's where duration can matter. So locking in today's yields and earning carry can be more effective than trying to time the next policy move. We've seen more day-to-day movement in rates and headlines driving short-term swings, particularly tied to oil and geopolitics. That's real, and clients are sensing it. But the magnitude and persistence of those moves have been limited, and for good reason. One key reason is the level of income investors are earning today. Yields are enough that investors don't have to run from volatility, and they can earn through it. With yields near or above multi-year highs across much of the bond market, investors are being paid to stay invested. That income acts as a shock absorber, reducing the need to sell into volatility and limiting how far prices need to adjust before demand reemerges. On the corporate side, fundamentals remain solid, limiting contagion across credit markets, and high-quality areas continue to see steady demand. The volatility has created dispersion and opportunity for active managers to capitalize on. The move into cash is understandable. Yields look attractive and volatility feels uncomfortable. But the real risk is opportunity cost and timing. Cash locks in today's yields, but it also requires getting the timing exactly right, knowing not just when to step aside, but when to get back in. Considering the dynamic environment today, if growth slows or if interest rates move a bit lower, that upside can be very easy to miss. By contrast, intermediate fixed income offers carry and optionality. Income helps cushion volatility today, and duration provides the potential benefit if we see a rally in the bond market. Advisors should frame this not as taking more risk, but as taking the right kind of risk to avoid missing returns over time. The recent repricing has created an attractive opportunity in the belly of the yield curve. It's rare to see yields higher than where they are today, especially in investment-grade corporates, which are above 5%. That's greater than where yields have been 74% of the time over the last 10 years. The belly of the yield curve is where income, defense, and upside potential all come together. You're not just clipping a coupon, you're picking up carry and roll down. Compared with cash and ultra-short strategies, the belly of the yield curve offers materially better expected return prospects. Intermediate maturities are long enough to provide downside defense if growth weakens, but short enough to avoid the fiscal and structural uncertainties that are priced into the long end of the yield curve. That's powerful asymmetry that cash does not offer. An attractive way to capitalize on this cheapening is to buck the trend and buy the belly of the yield curve. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.